Hey everyone, welcome back for another deep dive.
Excited to be here.
Today we're tackling something that's super relevant, I think, for anybody who's following businesses, especially in the tech sector these days, and that's this idea of float
Hmm.
and how it can sometimes make those like classic business metrics that we all love to look at, like ROCI and ROIS,
Yeah.
and a little misleading.
A little bit.
And guiding us on this journey is an investor named Mr. Schnitt.
Okay.
And he wrote this really interesting blog post called Eighth Wonder Capital Float and Invested Capital.
Catchy.
Yeah. So he's basically arguing that those traditional calculations for ROIC and ROS can get a little tricky
Right.
when you're talking about companies with a lot of prepayments,
Yeah.
like
For
SaaS
some of
companies.
these. Yeah. Subscriptions,
Exactly.
services in general.
Yeah,
Things that are recurring.
right, where they're getting all this cash up front. And so
Exactly.
that's kind of that float that he's talking about.
Exactly. Yeah. And, in those businesses, especially Sasha's, you think about the biggest ones out there, they're collecting so much cash up front for services they haven't even provided yet.
Right.
And it's like, that's a really good business model to be in because you have all this cash up front to invest and grow the business, but
But it can skew
it can totally spew
the numbers.
numbers. Yeah.
Yeah. So maybe just as a real quick reminder, what are those metrics? ROIC and ROS? What are we actually measuring there?
Yeah, so, at a high level, ROIs and ROEs are really measuring the return that a company is generating on the capital that it's invested in its business.
Okay.
So it's kind of a measure of efficiency.
Got it.
Like, how good are they at turning investments into profits?
Okay. So obviously we want to see a high number there. The higher, the better.
Absolutely. Yeah, you want companies that are making the most of their money, right?
Right. Exactly.
But that's where this whole float thing comes in and kind of messes things up a little bit.
Yeah. How so?
Well, the traditional way of calculating ROIC and ROS, it often fails to account for the future costs associated with delivering those prepaid services.
Okay.
So it's like we're saying, hey, great job, you've got all this cash on hand, but we're not really considering that they still have to actually provide those services, and that's going to cost them something down the road.
Okay. So it's like we're celebrating a victory before the race is even finished.
Exactly. It's like giving someone a trophy for baking a cake when they've only just bought the ingredients.
I like that analogy.
Yeah, so that's where things can get a bit distorted.
Okay. So how does this float actually mess with those calculations then?
Okay, so imagine you've got two companies, right? One's a traditional manufacturer. Let's say they make furniture.
Okay.
And the other one's that hot new sauce company everybody's talking about.
Got it.
Now, the furniture company, they've got a lot of upfront costs, right? They need to buy wood and fabric and pay people to build the furniture.
Makes sense.
They earn revenue as they sell the furniture. Pretty straightforward.
Mm-hmm.
The sauce company, on the other hand, they're collecting subscription fees up front sometimes for a whole year in advance.
Right. Yeah. That recurring revenue model.
Exactly. So they've got this big pool of cash that float before they've even delivered most of the service.
Right. So on the surface, they look super efficient because they're just swimming in cash.
Exactly. But here's the catch. They haven't actually incurred the full cost of delivering those services yet.
Oh, right.
They still need to invest in developing the software, providing customer support, maintaining their servers, all that stuff.
Yeah, it's not like those costs just disappear.
Nope, they're just lurking in the shadows, waiting to pounce.
So it's kind of like they've taken out a loan from their customers in a way.
You could think about it like that, yeah. And that's where Mr. Schmidt comes in and says, hold on a second, traditional ROACI and ROS calculations aren't really telling the whole story here. We need to account for those future costs that are tied to that deferred revenue.
Okay, so we need to look beyond the cash on hand and figure out how much of it is actually free and clear for the business to use.
Exactly. We need to factor in what he calls the expected cost of goods sold, or COGS related to that deferred revenue.
Okay, so we're adjusting the capital figure in those calculations to reflect the portion of that float that's going to be evened up by future costs.
Precisely, and that can drastically change how we perceive the capital intensity of a business.
Okay, back up for a sec. What do we actually mean by capital intensity?
Sure. So capital intensity basically refers to how much capital a company needs to generate a dollar of revenue.
Okay.
The higher the capital intensity, the more investment they need to grow their business.
So like a company that has to build a bunch of factories or buy a ton of equipment would be considered pretty capital intensive.
Exactly. And you can see how that float can make a sauce company look way less capital intensive than they actually are.
Right, because on paper it seems like they're generating a ton of revenue with very little upfront investment.
Exactly. But once we adjust for those future costs associated with that upfront cash, the picture might look quite different.
Okay, I'm starting to see how this could be a real game changer when we're evaluating companies. But before we jump into all the implications, let's unpack Mr. Schmidt's adjusted formulas a little bit more,
Sounds good.
because I think it's important to understand how those adjustments actually work in practice.
Definitely. Let's break it down.
All right, let's do it. All right, so let's get into these adjusted formulas Mr. Schmidt came up with.
Okay.
I'll admit math is not like my favorite thing,
Yeah.
but I'm definitely curious to understand, how he's accounting for these future costs. What's the actual math behind it?
Yeah, so at a high level, what he's doing is he's adding back a portion of that deferred revenue
Okay.
to the capital calculation.
Okay,
And the portion that he adds back is determined by the company's gross profit margin.
got it. So the higher the gross margin,
Yeah,
the more of that deferred revenue is kind of considered like free and clear.
exactly.
Yeah.
Because a high gross margin means that their costs are relatively low. So they're going to have more of that upfront cash left over after they cover those future costs.
That makes sense.
Yeah,
So, but I imagine this adjustment would affect different companies like to different degrees, right?
absolutely.
Like, a sauce company with a 90% gross margin
Yeah.
versus one with a 60% margin.
Totally. Yeah, that's one of the big takeaways here is that this adjustment isn't one size fits all.
Right.
It really depends on the company's business model and their cost structure.
So like, let's say we've got two sauce companies.
Okay.
They both have the same amount of deferred revenue,
Okay.
but very different gross margins.
Right.
So company A has a 90% gross margin
Wow.
and company B is at like 60%.
Okay.
How would that impact, the adjusted RARC?
Well, for company A with that super high gross margin, the adjustment would probably have a relatively small impact.
Okay.
Because most of their upfront cash is actually available for things like growth investments or even returning value to shareholders.
Okay.
But for company B with that lower margin, the adjustment is going to paint a much different picture
Right.
because a much bigger chunk of their deferred revenue is already earmarked for those future costs.
So their true capital intensity is a lot higher than it might appear at first glance.
Way higher, yeah.
Wow. So you could have two companies with like seemingly similar performance
Yeah.
based on those traditional metrics.
Right.
But once we apply this adjusted lens,
Uh-huh.
it's a completely different story.
Totally different stories, yeah.
Wow. So it really is about going beyond just those like surface level numbers
Yeah.
and understanding like the underlying economics of the business.
Exactly. You got to look under the hood.
Right.
See what's really going on.
Yeah. Look at the cost structure. How much of that float is actually like truly available?
Right. If you're just looking at the cash on the balance sheet, you're missing a big part of the picture.
It's like a detective stories almost, right?
Yeah.
We're peeling back the layers.
Absolutely.
Looking for clues.
We're financial detectives.
Yeah, exactly.
We got to use the right tools to find the truth.
And Mr. Schmidt is giving us one of those tools.
He's giving us a magnifying glass.
Yeah, especially when we're looking at these businesses with these high prepayments.
Yeah, those are the ones where this adjustment really matters.
I can already see how this would impact like investment decision.
Oh, yeah.
You might be tempted to invest in a company with a really high ROIC,
Mm-hmm.
but once you adjust for that float, it might not be as attractive as it seemed.
Right. Or on the flip side, you might find a company that looks kind of meh
Yeah.
based on the traditional numbers.
Mhm.
But when you adjust for the float, suddenly they're a rock star?
It's like we've been given this secret decoder ring
Yeah.
to understand financial statements.
Totally. It's all about context.
Yeah.
It's not just about the numbers themselves. It's
Mhm.
about understanding what those numbers actually mean.
This is why we do these deep dives.
This is it. This is the good stuff.
It's like, connecting the dots, seeing the bigger picture.
It's all about the big picture.
Yeah, and I think this is like especially relevant, like you were saying before,
Yeah.
with so many companies these days, especially in tech, using these prepayment models.
Oh, yeah. Subscription businesses are
Yeah,
everywhere.
you can't avoid them.
So if you're investing in those companies, you've got to understand this stuff.
It's essential. Yeah.
It's not just for investors, though.
Right.
This is important for anybody who's involved in business.
Yeah.
Whether you're an entrepreneur, a manager, an analyst, this knowledge can help you make better decisions
Totally.
about how you allocate capital, how you set prices.
How you even evaluate your own company's performance.
Exactly.
Okay, so let's do like a quick recap
Right.
of what we've learned so far.
Right.
So we've got this float, which is that upfront cash from prepayments.
Yeah.
And it can create this like kind of misleadingly positive picture
Yeah.
of a company's capital efficiency
Right.
if we're just using those traditional ROIC and ROS metrics.
The old school way.
Right.
Doesn't cut it anymore.
And so Mr. Schmidt is coming in with these adjusted formulas that factor in the future costs
Right.
associated with that deferred revenue.
Got to account for those costs.
And this is especially important for businesses with those high gross margins.
Absolutely.
And these adjusted numbers can have a big impact
Huge.
on how we view investment decisions.
Yeah, they can help you avoid some traps
Right.
and uncover some hidden gems.
Exactly.
It's all about thinking critically,
Yeah.
not just taking the numbers at face value,
Mhm.
understanding the context, the business model, the nuances behind those metrics.
Yeah, it's about understanding the whole story,
The whole story.
not just the highlight reel.
Exactly.
Okay, so we've unpacked the concept. We've looked at these adjusted formulas.
Yeah.
We've even started to see some of those real-world implications.
Mm-hmm.
But I'm curious, like, how would you actually apply these adjusted metrics
Yeah.
in the real world when you're evaluating, actual investment opportunities?
That's a great question.
What are some things to look for?
Yeah, like it's one thing to understand the theory,
Right?
but how do we actually put this into practice?
Yeah.
So there's a few key things to keep in mind.
So, like, practically speaking, if I'm comparing two SaaS companies,
Yeah.
one that looks really good based on, like, traditional ROIC,
Mm-hmm.
but they're really relying on that float,
Right.
versus another one that maybe has a lower ROIC, but it's been adjusted.
Yeah.
Using Mr. Schnitt's method, what are some, like, red flags or green lights?
Okay, yeah, so that's where you really got to put on your detective hat.
Right.
And start digging into the details. So first off, I would look at their gross margin trends.
Okay.
Is that gross margin stable? Is it going up?
Mhm.
If it's going down, that's a warning sign because
Okay.
it means their costs are rising, which eats into that float and makes that adjusted ROIC look less appealing.
So even if their revenue is growing like crazy,
Yeah,
we got to make sure that their profitability is keeping up.
exactly. Top line growth is great, but it's meaningless if they're not making any money.
Right. It's got to be sustainable.
Exactly.
Okay. So gross margin trends. What else?
Another thing I'd look at is their customer acquisition cost, or CAC.
Okay.
How much are they spending to acquire each new customer? If that CAC is growing faster than their revenue, that could be a sign that they're burning through that upfront cash
Okay.
just to chase growth.
To juice those numbers.
Exactly. And that's not always a sustainable strategy.
Right. We want to see companies that can acquire customers efficiently
Yeah,
and profitably,
for sure.
not just, light a bunch of money on fire.
Nobody wants to see that.
Okay. So gross margin trends, CAC, anything else?
Definitely. I'd also take a close look at their investments.
Okay.
Where are they putting all that float money?
Mm-hmm.
Are they investing in things that are going to drive long-term value?
Right. Yeah.
Like R&D, product innovation, a solid customer support team.
Yeah. Stuff that's going to actually build a good business.
Exactly. But if they're just using that cash for like flashy marketing campaigns
Oh, yeah.
or acquisitions that don't really make sense,
Mhm.
that could be a red flag.
It's like they're trying to distract us from the real issues.
Maybe a little bit, yeah. You always got to be wary in those shiny objects.
So it's all about understanding their priorities and making sure they're focused on building something sustainable.
Absolutely. You want companies that are playing the long game.
The long game, that's what it's all about. Okay, so we've got gross margin trends, CAC investments. Are there any other financial metrics that can help us kind of
Yeah.
see through this float illusion?
Yeah, for sure. I would pay close attention to their cash flow statement,
Okay.
specifically their operating cash flow.
Mm-hmm.
You want to see companies that are generating strong operating cash flow, even after you adjust for that deferred revenue,
Okay.
because that means their core business is actually producing cash.
Right.
It's not just a bunch of upfront payments propping them up.
So strong operating cash flow is kind of like a seal of approval.
Pretty much, yeah. It means they're actually making money, not just collecting it.
Okay, so it sounds like evaluating these companies with high prepayments, it's like a whole different ballgame.
It is, yeah. You can't just rely on those traditional metrics.
Right, we got to dig deeper, be a little more skeptical.
Exactly. You got to be a financial detective.
I like that. And, Mr. Schmidt's adjusted formulas, they're a great tool,
Yeah, they're a good starting point.
but we still need to consider the whole picture, right?
Oh, absolutely. The competitive landscape, the management team, the overall market trends, it all matters.
But understanding this whole float thing and how to adjust for it,
Yeah,
that can give us a real advantage.
huge advantage. Yeah, it can help you spot potential problems and hidden opportunities.
It's like having X-ray vision for financial statements.
I like that.
All right, so dear listener, next time you're out there evaluating investments, remember what we've learned today.
Yeah,
Don't be fooled by the float.
don't let it trick you.
Look beyond those ROIC and ROAS numbers, especially for companies with a lot of prepayments.
Exactly.
Do your homework.
Ask the right questions.
Yep.
Make sure their business model makes sense.
Long term.
Yeah, it's all about the long term.
All right, well, this has been another fantastic deep dive.
I had
I
fun.
feel like I've learned so much.
That's what it's all about.
Yeah, so until next time, happy investing, everybody.
And may your aura be ever in your favor.
I like that. I like that. I like